Hello, this is Dave and welcome to Equity Story. I apologize, the video's a little bit late. It's all Claude's fault because when he starts talking, he doesn't stop. And anyway, this is just general share advice and not personal advice. And let's get going now. I suppose before we start anything, Claude, and before we give away our wisdom, which is there's a lot of wisdom coming today, we need to have a look at the general markets and not looking good. So, funny enough, when you look at trends are often, or market trends, you need to look on monthly charts. So monthly charts often give you a very strong indicator of what's going on, and you can see we're nearly coming to the end of the month, Friday, and that price action is absolutely terrible. And you can see the last time, really, apart from COVID, we broke that monthly trend was back in 2008, and the market went down a lot more. And what I'm hearing, Claude, off the the general chit chat is that the analysts, and you're an analyst, right? So you maybe answer this question better than I would. Most of the analysts in America haven't really factored in that we're going to get a decent recession in America and possibly a world recession around the world, and possibly those P ratios need to be re-rated, and that's what's going on at the moment.
Yeah, look, absolutely, Dave. It was, fundamentally, I have been bearish for most of this year, at least 6 months now, and I was writing about there's nowhere to hide on the ASX. I think 6 months ago. So the thing is, I keep on getting. I know it wasn't. I only wrote that in June, right? But it's only a few months, but I still already get messages from people saying, "Oh, has it bottomed out now? Sentiment's bad." But my answer is just no, because it's not just sentiment. It's not just the headlines you're looking for. Yes, they can be an important sociological cue that there's blood on the sheets or that there's a lot of fear out there. But you also need to have a look at the valuations of things and what those pricing in, essentially. And we're just not there yet. Things aren't so cheap that you'll get a whole bunch of money coming in. Now, don't get me wrong. If suddenly inflation gets under the control and interest rates start going down, then I think we will see a reversal. But in the absence of that, I think you got to stay cautious. I ran the valuation of a bunch of companies over the weekend because I often leave my work to the weekend just because markets are closed then, so I find it easier to focus on the spreadsheets. And almost everything to me is still like a little bit too expensive once you do increase a few of those discount rates based on the fact that interest rates are a little bit higher. So there's a lot of downside risk until we know inflation is under control. And for that reason, fundamentally, I remain cautious basically until those valuations start getting more compelling.
All right. So can we talk about one stock today? One stock that we do like, and which is ALC. We spoke about this one, and obviously it's not trending, and it might not trend for a long time. But for those long-term investors who are looking to nibble at a good story at a good price, we're now down at 12.5 cents. We look at this a little bit earlier, it was at 13.5. Now it's at 12.5. It's starting to look compelling, surely, Claude, for that long-term investor looking to slowly build a position in the stock over the next sort of 2 or 3 months.
Yes, well, I definitely think so. So I, full disclosure, already own this one and recently bought it at slightly above higher prices, but I only bought a tiny bit because I guess I sort of see it as a process of building a position. So what these guys do is hospital software. So it's very sticky. The demand's not going anywhere. Most of their clients are governments. They're not going to so their clients aren't going to go bankrupt. Their clients also aren't going to like change around product easily. So they've basically got a reliable business there, and they are unprofitable. Therefore, most of the value of the stock actually comes from future profits. Now, what happens when we have the current environment where you have high interest rates is that has a disproportionately large impact on a company like Alcidian, that has most of its value coming in the future. So that's why we've seen the share price down. That's why, like, even I've had to lower my valuation of this kind of thing. But at the same time, you know, this is a company that is very likely to be around in 10, 20 years from now. It's well run. The CEO has, you know, a substantial amount of money in stock. And most importantly, she last bought shares at around 13 cents. Now that was back in March 2020, but she last bought shares at around this price. And if anything, I'd say the company is a more compelling business now than it was back then. And look, because this is a software healthcare company, it can get super hyped up, and perhaps it did get far too hyped up for a while there. But essentially, you know, this is going to be a good business, and most importantly, it's definitely going to survive whatever happens. But it's going to get lumped with companies that might not survive, and that's where you get the opportunity. I don't know when it'll bottom, but I already think that it's at a point where in the long term, it's undervalued right now. And I own a little bit right now. The only reason I'm not going in massively is just because I don't want to just buy it undervalued. I want to try and like get it as cheap as I can. And I feel like sociologically there's room for more downside there. But if I don't emerge from whatever recession that I think we're going to go through with a good holding in something like this, then I'm going to be really annoyed at myself. And I will make sure that I do, because this is the exact kind of thing that I look for. It looks kind of ugly now, but it's at an inflection point in its business journey where in a couple of years, it's going to look like a much more robust company.
So you've had a little nibble here. Most probably if it went down to 10 or 11, a bit more of a nibble. If it went under there, maybe nibbling a bit more. And
I think there's probably, I think we were saying off air before, like a lot of people probably buy this at 10. That's like that round number thing. Yeah. But like, I'd probably do the same. Like, even if it went below 10, look, I just think at 10 cents, it's going to be very likely to exceed that in terms of its valuation. It's not that hard to imagine where, you know, talking about a company now that, just let me get the numbers up, but I think it's like it's tens of millions of revenue, and it's not unusual for a software company to make, so it's 34 million revenue last year. Looks 23.3 million recurring revenue. It's not unusual for a software company that's at maturity to make 30-40% net profit margins on its revenue. So give it a few years. I think we see recurring revenue up at say 30-40 million. Let's just say 30 million. If you get a 20% margin on that, that's 6 million net profit after tax. And at a 10-cent share price, you know, you're talking about maybe 150 million market cap. So at that point in time, you'd be looking at a company that is got a high margin, really high quality business on 20 and still growing on 25 times earnings. It's going to go higher than that, in my opinion, long term. It's just you might need to wait a few years to play it out. And, you know, that's basically the joy and the pain of being a long-term investor, is you just have to wait a really long time, and you don't know when you're going to get the share price payoff. But if you do pick the right ones, then it can be really good.
All right, so ALC is definitely on that list. Now, Claude, we did live on Friday. You had to leave earlier, so it was a bit of a quiet Friday, so we cut it a little bit short. Now, you went on TV, and you went on TV to talk about two stocks. So what are you talking about, mate? Share all.
So a bit of look, giving away the good stuff. Look, so it's hard to find stuff that I'm really bullish about right now, just given the market situation. But like the number one stock that I'm planning to buy next is probably Energy One. Now they've got a capital raising going on at $4.50. So that's why I'm going to be buying more shares. I'll be buying more shares at $4.50 under the capital raising, because I already own shares in this one, as I also own shares in Alcidian. But these guys are a bit better than Alcidian because they're already profitable. And look, that profitability is really just an evidence of the fact that unlike Alcidian, which is really in that sort of rollout stage, and it's in a more competitive market, Energy One has like around 50% of the market in software for wholesale trading in Australia. So it's kind of dominating a profitable niche in Australia, and that's sort of allowing it to be profitable. It's also used that and leveraged that position to grow into Europe, where it also makes a profit. And so there, it's like a more mature business, even though it's the same size, because it's bigger relative to its niche. So operating revenue of about 32 million, statutory net profit of 3.6 million, right? So that's about a 10%, a little bit more than 10% net profit margin. And previously, by the way, I should say, like in FY 2021, they had a net profit margin of higher than that, being like 13%. Either way, these are not at maturity net profit margins because the company is still investing in its growth. So yeah, basically, this has still got a lot of improvement to do, but it's already a pretty hardy business, and they're just raising capital basically to get their balance sheet a little bit stronger, as they'd use some debt to make an acquisition. And look, I won't go too much into too much detail with it. I think that you can see a write-up of the results on A Rich Life for this one, but yeah, that was one I talked about, and that's one that that's probably like, that's the one that I'm planning to buy when I get my entitlement offer documents.
And actually, when you actually look at the share market performance, it's been very, very good in a very, very tough market, which is an excellent sign, isn't it?
Yeah, the companies like this have been by and large absolutely smashed. So it's been super resilient, and it should have been smashed harder, basically.
All right, and I suppose that was a good raise then, if around 450.
Well, I wish I could know what the institutions that they got on board in their raise is, because they've said, oh, we've been doing it because we wanted to like get these institutions on board. But yeah, let's hope that they're good institutions that are going to be there for long-term holders, and if so, that's actually just going to increase the resilience of the company and give it a better position to be able to take opportunities. Because if they've got access to all of these institutions that believe in the story, have plenty of money to deploy, they're long-term holders, then if we do have a recession and really bad markets, yeah, it's going to be bad for the EOL share price. But at the same time, they'll probably be in a position where they can raise capital and make smart acquisitions at attractive prices. So I think that, these guys, they're playing the chess game properly, but all of these small cap software growth stocks are getting hit at the moment. So it's not a surprise to see the share price lower.
Thanks, Claude. And that's another one basically with ALC, look to maybe nibble away at over the next few months. Now you spoke about another stock. Which one was that one?
Yeah, another one I talked about was Audinate. This is another one I own a small amount of shares in, but just a great deal of interest in this because I've held it for a long time, just a small amount, because I really admire the business, and been waiting for it to get cheaper. So for forever and a day, been waiting for this one to be finally the setup. I first bought it, by the way, and recommended it years ago, but I then sort of sold shares and stuff. So I sort of traded it a bit and didn't end up with a big position. Look, what these guys do is they make a chip that allows sound waves to be converted into Ethernet cables and transmitted around audio systems through Ethernet, rather than traditionally you've got the cord, right? Which is like copper wire. So Ethernet's cheaper, faster, allows computers to control where the sound goes, basically better functionality. Look, the long-term thesis for this has always been basically that you have all the manufacturers, they be Yamaha, Bose, Bosch, whatever you want to think of, basically. They, in order to have their equipment all talk to each other, they need to have one of these chips, because this kind of chip, the Dante chips, they are the predominant ones. So it kind of gets to the point where if you want to have audio equipment that needs to be in big network systems, you need to buy one of these chips. Now that is the exact setup you want, because Audinate's chip is a smaller part of a bigger thing. So if they sell their chip for $30 and then they put up the price to $50, that doesn't really change the overall price. If the thing that it's going into is something that's worth $1,000, it's gone up from 1,000 to 1,020. But that's a massive price rise for Audinate itself. That's the dynamic we're talking about. They can put price rises up considerably without overly damaging the attractiveness of the product to the end customer. And their customer doesn't really have a choice, arguably, about whether they put this chip in, because it's going to make their product way less attractive if it can't network with other devices from other makers. That's the theory. The reason that I'm upgrading these guys to like one of my higher quality stocks finally is because that has been the theory forever and a day, but they never really proved it. Then they got inflation, and that put their costs up. So because they had their costs up, in order to not lose money, they had to put up their prices, which they did no problem. So that proves they can put up their prices. Only issue is right now their costs are going up due to inflation, supply chains problems, blah, blah, blah. That's all a negative, don't get me wrong. Hence why my valuation is below the current price, but I'm holding on now. And similar to the Alcidian story, but these guys are a higher quality business in my opinion, because whereas Alcidian's always going to be in like a competitive environment, these guys have got something that starts to look like, a quasi-monopoly. Definite, you can say what their competitive advantage is and why, and the source of their pricing power. And that's what you really want to look for as a long-term investor investing in quality buy and hold growth stocks.
Oh, okay, so what's your valuation? What's your buy price on AD8?
All right, only giving one of these though, because this is the stuff for Rich Life subscribers. But my buy price range, this is not my valuation, but this is where I desire to buy it, is between, at the moment, $5.15 and $5.69.
So similar to just near those lows there, around there.
Yeah, pretty much.
Okay, that's some good advice there. That's some excellent advice. So that's two three interesting stories there, Claude, that obviously as this market tumbles down, those opportunities are starting to appear, aren't they?
They are, but it's still too early by and large, because most of the time when I'm doing these valuations, it's coming out a little bit below where we are right now.
Right. Just very quickly look at the general market. Unfortunately, there was very little trending. I think I went through 2,500 stocks on Sunday, and we only had 10 that looked like they were trending. Funny enough, two of those, you gotta love it. MTC, which looks very good in gas. Surprise, surprise, both came out with good announcements this morning. So, obviously the people in the know were buying, but they haven't really done much with it. Costa Group, as a goodbye to the CEO, Sean Halloran, is stepping down, and the market seems, I don't know, seems very upset with that. So Sean's gone. I thought the market would be happy. I thought they'd be going up. I don't think he's really hit his stride, has he, over the last
well, look, I don't know if there's anything you can do to make this a good business, basically, because essentially this is a farm or a farmer, but they don't own their land. That's what you want to own, the land, right? But they're just the farming business, which is a really tough business, capital intensive. They've got a lot of equipment to maintain. They have huge, workforces to have to manage. And, they have so many risks with like spoilage. There's this whole, distribution network that they sort of rely on to make their money. So it's a difficult business to manage. It's a capital hungry business to manage. It's a business that its profits have been going backwards, even as its revenues go up. So obviously that's signs of competition there as well, which of course in food, you're going to have a lot of competition. So very tough business, but the cherry on top of all of this is, I think it's about 470 million or a bit short of that in debt. 470 million in debt against a profit of 48 million in the last half year. So look, that even if you generously said 100 million, you've still got over 4 years of profits in debt. So if they wanted to pay off their debt, they'd have to have at least 4 years of cut their dividend, and that's even assuming they didn't have capital expenditures required. So realistically, they'd take half a decade minimum probably to pay off their debt, and realistically probably even more than that. So super indebted company. People probably just taking the CEO heading off as a sign that things are going awry. And when things go awry on a heavily indebted, capital intensive company, it can get super ugly.
Yeah, it doesn't look good. And I suppose in all fairness for Sean, it is a hard business, and you've got weather factors that can play a part as well. And
it's a tough business. You wouldn't want to run it.
COI, good news for them that Santos have come in and they've taken their options. They did have a big raise recently, and I think that hopefully is a good positive sign for the company. I think, Claude, I can end the last thing. I'll end on a BDM. So I had a few calls and people saying, Dave, what are you doing putting a hot stock on? The world's collapsing. So I've got a story of this one, and I'll share it. The story goes a long time ago. A family office, lovely people came to see me, and they said, Dave, you need to have a look at this little CIA, right? And I had a look at it, and it was a really interesting business that Michael O'Keefe and a whole group of investors, they bought off for I think $10 million off Cleveland Cliffs, and they got it for a song. So, and in assets, this business had 2 billion assets, and Cleveland Cliffs basically got rid of it for nothing. And the story turned out, obviously, one day this became a $1 billion company. So Michael O'Keefe's tremendous record. He's got a tremendous record. He had a fantastic record on Riversdale, which he sold to Rio Tinto for $2 billion. So he's the guy. The guy is very, very successful. So when the same group say to me, Dave, you want to have a look at BDM? I had a look at it, and it's very interesting. So this again is a Michael O'Keefe special. You know, I think he owns 7 to 8% of the company. It's on the. They've got some good, interesting people on the board. They've got the guy they brought in from De Beers. But the first thing I liked about it, Claude, I like the price action. So for me, that's a good sign. When I had a look at the story, I don't think the market is really calculating that revenue is they're starting to bring in revenue, and what they're specializing in is yellow diamonds, orange diamonds, which retail between 5,000 US and roughly around $50,000 per carat. What they're looking to do the first year is sell 1,200 carats, which isn't a lot of diamonds when you think about it. It's about, I reckon, it's about 200 or 250 diamonds. But the potential to scale this up to 5,000 diamonds and 10,000 diamonds is obviously very interesting. You know what? The world's going into a massive recession, and this is I was, you know, are people really going to be running around buying yellow diamonds and orange diamonds? I think, you know, unfortunately, the way the world is at the moment, I think the rich are always rich, right? So tend to have money, and the people who sort of spend money on those sort of things tend to, you know, not be, it can get affected, but not maybe as badly.
They're insulated from it a lot.
Yeah, and also I think, you know, whether they might not sell 10,000, but if they sell 5,000, the numbers are huge in this business. And where it's interesting, Claude, they've got 2 diamond mines. Not only are they finding diamonds in the field and cutting them and taking them to market, but they're also buying diamonds. So, you know, if it's really interesting, if you knew how many diamonds there were in the world, right, the diamonds would be worthless. De Beers have got I think millions of these just locked in vaults, right? They just put them out slowly to give value, because, you know, if you've flooded the world with diamonds, I mean, I think your watch would be worth more money, right? But the yellow diamonds are rarer. They're more interesting, and the orange diamonds, as well as the Rio Tinto's red diamonds. And the interesting thing is, Rio Tinto used to own this diamond mine, and they sort of lost interest in it and decided not to push it anymore, because it's not their focus. Rio have got better focuses at the moment than really yellow diamonds.
Yeah.
It's a little bit of a specialized. So again, I think
so it could be a bargain purchase again when they got it off Rio Tinto.
That's and all I'm saying is that we'll watch this one carefully, right? And I'm not saying you know, run out and buy it, but certainly have a look at it, maybe have a nibble. But it's going to be very interesting to see how this company progresses over the next few months. And I would expect it can't be long until we start seeing some revenue coming in. So maybe just that interesting time to start looking at a little company that's finding its feet, that's just about to hit revenue, Claude.
Yeah, thanks, Dave. Yeah, that's an interesting one to put on the watch list, and probably, you know, going to depend more on how the company itself goes and whether its plans work out than anything else. So maybe somewhat uncorrelated to markets there.
Yeah, so a little bit interesting. on that note, I'd very much like to thank obviously Claude for being with me. That's always absolutely brilliant. And Claude, we got live tomorrow night at 7 o'clock.
Yeah, that's right. I'll see you then.
All right, thanks, Claude. See you, mate. Take care.
Bye.
Bye bye.